Hey, what's going on, guys? Mac here from uh, nowhere. I got you there. It's just Mac here, back with another stock trading series. Back at you. Sorry, just got to move my mic really quick. So we're gonna be talking about a special little something. This is more of a tutorial, so to speak. Um, Not really a tutorial, but sort of like an informational guide onto pre-market and after market trading, or just pre-market and aftermarket. So if you guys don't know what the pre-market or the aftermarket is, we'll just take a look here at Amazon. At around what is that? 13. So basically, at around like midnight, I think it is, or so to speak, midnight, you sort of get this buyers and sellers, sort of throughout the day, sort of throughout the night. It could be really small, it could be really light, but we'll just look here, really, not early in the morning, but like at around 6 o'clock, so to speak. So this right here is what you get. You get stuff like this. Okay, you go from 989.75, and then you go to 989.50. That's what, 20 cents. And then you go down to 989.32 up to, stay flat. You sort of curve here at about 989. It goes down, and as you can see here, they're like, what is it here, from 989 to like 986, and you can see here that it's really wimpy, so to speak. Okay, if I could say that, it's like really wimpy. It's sort of flat, nothing's really happening. It's just like, ugh. It's sort of like an old man sort of treading on ice, and that's what I sort of think of the pre-market and the aftermarket. Is this right here is what, you know, sort of what, okay, that was like really bad, sort of what the aftermarket and pre-market sort of look like. And you get this like really sort of like, if I could ever, if this would ever work, let's just go back to the brushes here. I want something really thick. So you get something here that's like, my apologies, guys. Why do I do this to myself? Anyway, basically, you get something that's sort of thick, sort of like a really straight line. Or no, this right here is mid-market, okay? Let's just say here you throughout the trading day, and this is basically like ice, okay? Think of it like ice. Okay, you got buyers and sellers, and they're sort of trading on ice, so to speak. But this right here is pretty thick ice, so it takes a lot of buyers and a lot of sellers to move the price down. So it's pretty thick, and it might take a lot to move a price down, depending on how many people are buying and selling. So you could sort of get the gist. I know it looks awful. But when you go to the pre-market and the aftermarket, it's really thin. It's like thin ice. When somebody sells at the market, which basically means he's getting in at the best possible price. So, like, let's say, he wants to basically buy, like, right at 64, or wherever the market is. So, let's say the price is at 65, and there's a seller here at 55. He's going to pick up that seller and take the loss, and the price is going to go up because that seller got removed, and depending on how many contracts he bought, not contracts, sorry, I'm thinking of futures, but basically how many shares that he bought is going to move the price up. And let's say here you got like a row of buyers and sellers right here, and somebody buys, let's say here it's 50, 60, 70, 80, and he buys it all up, the price is going to go shooting up. And But when it comes to like mid market, you know you got to fill a lot of orders that could be like here, a lot of sell orders when you're on the buy side. Now, if you're a seller, it goes for the same thing. And when it's mid market, you know it's pretty hard to buy up everybody. You know, buy up all the sell orders. But when it comes to really thin trading, you look here at the prices here. What do you got here? You got 5 sellers waiting to get in at 988. So basically, they're basically waiting to get filled. They're waiting to get filled by a buy order. So like, let's say here I bought at market. They're gonna find the best person that's selling their shares. Which that's why they call it trading. You know, we trade stocks. We trade it for a certain amount of price. And so yeah, that's basically what it is. Now, when it comes to the mid market, so to speak, when you're in the mid market, I would say at about 12 or 1 o'clock. Actually, let's go to like 10 or like 10:30 maybe, because volume starts to slow down a little bit, but you still get your volume, okay? So we'll just kind of thicken this up. So basically here, you know, it's sort of like a trend up and down, and it's really, you know, actually, hold on, let me just remove this. It's really sort of staying in that line because the volume is bigger and there's lots of people buying and selling. So it sort of stays within the ice. But when the aftermarket is there, you know, it could be a buy here. You know, it could be something like that is like that. You know, the ice can be really broken through, and sort of with like mid market, you know, it's harder to break through that ice because there's buyers and sellers everywhere. If you guys can, you know, see what I'm telling you. So it could go flat line, and then it could, you know, sort of stay flat, and then it could pop right up to here and then drop down, stay there, and then it could go straight up, and then it could go here, here. So the ice gets, you know, if you have ever like gone ice skating, so to speak, if you've ever gone like ice skating on really thin ice, you could plop right through it. So think of it as like you're popping in and out of ice, and it's really quick. So like, let's say you're beneath the ice, and I guess you have like a jetpack, you could go like really, you know, quick through it. But if, you know, and you're not really going to get hurt because it's really thin ice. But when you're in the mid market, if you try to, you know, like let's say you're falling from the sky and you got a jetpack on, it's going to be really hard to break through this ice because you got the buyers and sellers below there, and there's a lot of liquidity, money being transferred through in and out really quickly. But when it comes to the thin ice, like I have said, the pre-market and aftermarket, it's really easy to break through. Because the spreads, if you guys do not know what a spread is, basically the difference between the buyers and the sellers. So they're selling at 98.6.77, and they're buying at 98.88. So you can tell the spreads are fairly wide. And this right here is on Amazon. Same thing goes for Facebook. You know, you got 40-cent spreads. So like, let's say here you wanted to sell. Let's say here you bought at 170, but then you wanted to sell immediately. The best possible seller that's willing to give you their shares is at 169.60. So you're going to take a 40-cent loss on each share. And people that usually trade pre-market and aftermarket really try to get the price up there. Like here, what is it? Facebook was trading at, you know, it closed at, what is this, like 168.59. And then like throughout the day, you'll see something like this and be like, oh, I'm rich. Well, you're really not, because it's, you know, the pre-market and aftermarket. And then it starts getting spiked up, and it looks really wimpy, you know. Think of this as like thin ice, you know. It breaks through, it, you know, drops. You could even see stuff like this. We could check out AMD as well. You know, you get stuff that looks like this. And AMD is a really bad example, because if you look here, I mean, this is just chop, 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 chop. It, you know, it tells me that the spreads are like 3 cents apart, and I think they actually are. I mean, stuff like this. So you can move the price down a lot, and it could cause people to panic. So when volume is very thin, okay, when there's more sellers than buyers, and the volume is really thin, we get stuff that looks like this, okay? Let me just show you the NASDAQ futures, and you will see what I am talking about. Hold on. Let me just see here. One year, 1 week. No, that's a really bad example. 20-day, 3 hour. You know, when you're trading, you know, let's see here. What was it? I think this right here was last Wednesday. Yeah, last Wednesday or Thursday. Yeah, Thursday. The NASDAQ here reached an all-time high. That's because there was more buyers than sellers, so they were picking up all the sellers, and the price was going up and up and up and up. But then what happened is that the volume was really thin. Like we say here, the volume was really thin, really shallow, easy to move through, in and out, rather than, you know, stuck in the little, like stuck in the ice. You can't really break through, in and out too much. And what happened is that, you know, somebody probably sold 100 cars, which is 100 contracts, I think. And, you know, it just starts ripping and starts ripping lower, and then everybody's like, oh God. And so then the sellers start picking up the buyers, and there's too many sellers. So the price gets really ran down because all the sellers are selling at market. So let's say here, let's say here, for instance, this right here is not going to match this, but so let's say here you see something that's like 300, 700, 800, 900, 10,000, which you would see here, and then you would get your buyers down here. And all the, you know, and basically here the sellers who were picking up all the buyers at market. So like it might be like 100 there, somebody bought 100, now the price would move down, and now you got this right here, which could be 200. A seller here picks off the 200, now it's going down. And the thing is that the NASDAQ actually moves pretty rapidly, better than the ES, which is why I like trading the NASDAQ futures. So the NASDAQ here, when it sells, but it comes back pretty quickly. Like you can see here, it starts retracing up, but that's like after a couple days. So, you know, the volume here really starts ripping. Not the volume, but the price really starts ripping. So, like I was saying here, the volume is very light. I mean, look at what you got here. The volume is really light. Volume picks up a little bit, does a little bit of selling, does some buying, but again here, you know, the volume is still low. It's relatively still low. And then the sellers, you know, person panic sells, goes down, people panic sell, boom, 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 and that's very thin volume. You know, never trade thin volume. Now I'm not telling you what to do, but it's pretty risky. You know, some people are just like playing with stocks, and they're like, oh, excuse me. You know, like here's a really bad example, but I'm sorry. You know, people are like, no, that's too bad. Let's do something like this. You know, when it comes to pre-market, you get people that like really prop it up. Let's say, okay, you know, I'm doing good. You get a short, I don't know, like let's say here I bought right here. Okay, good. If you even get filled. Good. Oh, down. Okay. Oh, you know, you could get really wiped out. Not wiped out, but it could be a little bit risky. So that's basically what pre-market and after trading is. Now, when it comes to earnings, you know, when you see a stock soar when earnings come out, I'll show you exactly, or I'll show you why it happens, or why does it do what it does, so to speak. And I'll show you here, like we said, okay, like we had said, the volume becomes very thin. You know, the exchanges close. People get, people are let out of work. But institutions or hedge funds, start putting in their buy orders. They wait out for earnings. Like Tesla reported earnings, and the stock jumped like $20 or 20 points. And so here, if we look at this, and we could sort of, I don't use candlesticks. I'm really sorry, but I just don't use candlesticks. But if we look at something, that's like Tesla, when earnings come out, the volume is very thin. So what we get here is we get this sort of, it could break through really easily. It could break through the ice really easily. So when it goes from like here down to here, it could really fluctuate. So when the earnings are good, and they release it, and this is if they are good. If the earnings are good and they meet expectations or above expectations, it's going to go up. But I'm going to get rid of the fact that, it could not be the best, or it's not the best. I'm getting rid of that. I'm just going to say here, if earnings are good and they beat their EPS and it goes up, okay, great. So the buyers could basically be picking off the sellers, and there's more buyers and sellers, so it goes up. So they would buy at market, extended hours, and they'll basically, let's just say here we got 17 there, 3 there, 4 there, 6 there. The buyers basically pick up all of those, and the stock like soars, like 10 points automatically, and it keeps on going up because all the sellers here are getting picked off, and all the buyers are buying at market. So it really just starts getting huge, and then it goes up like 20 points. That's basically what it is. It's really simple, dangerous to trade in, but if you like trading that, and if you could get filled, that's great. And that's what that's what I have to say. Thank you guys so much for watching. I really appreciate it. If you want more stuff like this, like leave a like, subscribe maybe, or if you don't like this, tell me you don't like it. I really don't care. And so yeah, have a good one. Peace.